Well, you know the saying, sell in May and go away. Although it doesn't rhyme, maybe it should be sell in June and go find a beach somewhere. The Dow Jones Industrial Average down for the 8th straight session, underscoring specific issues that face these multinational names that are getting the vast majority of their profits. Remember, their profit growth comes from outside this country. So, yeah, it's the trade battle, but also the strong dollar at an 11-month high and a weaker global economy. Now, on the other hand, we have seen a magnificent rally and amazing numbers, records for NASDAQ and the Russell 2000. Even today, while there were 83 new highs versus 81 new lows on the New York Stock Exchange, we saw 154 names on NASDAQ close at 52-week highs, only 58 at new lows. Still, I will say there's some things that are bothering me and, of course, hurting my model portfolio. Let's talk about the yellow flags, construction stocks, right? I've been pounding the table on the S&P material names. That sector's down for the year, and there have been a lot of false starts there. I think one of the problems is an absence of a catalyst, particularly with U.S. construction. Those names really getting hammered. I had it as a big investment theme coming into the year, by the way, with or without massive infrastructure from Washington, D.C. Also financials, which I've been underweight, thankfully. But I got to tell you something. All the mavens, every brilliant mind on Wall Street all year long has been saying, you got to own the financials. Well, something seems to be wrong there. The S&P financial sector, it's off for the year. But I got to tell you something. It really doesn't tell the story of the carnage in these big money center banks like Goldman, which is off more than 10%. So what's the booster shot going to be for these guys? Well, maybe they get a booster shot from news that came out after the close today. Now, I know this sounds more like the latest movie from Dwayne Johnson, but not even a rock, I think, could survive the circumstances assumed in the Federal Reserve's stress test, right? Particularly the more dire hypothetical economic downfall scenario that they envision. This right here, it's broken. First of all, the stress test itself is broken into three categories: baseline, adverse, and severely adverse. We got that after the bell. So think about this. We're talking in the midst of a global recession, U.S. unemployment above 10%, a steepening yield curve, stocks down 65% into 2019, the VIX at 60, housing values down 30%, commercial real estate down 40%. Well, after the bell, the Fed said that if we get those conditions, surprise, all 35 banks would pass. Well, you know what? We're talking hundreds of billions of dollars in losses, blood in the streets, stress that I think would be just, I don't believe this stress test. And I would say, though, hey, if they do believe this is true, this is a great time to get the banks to pledge that they would not ask for or accept a taxpayer bailout. Now, I still want investors to focus on the fundamentals, but that doesn't mean you ignore sort of signs and messages from the market. And right now, the message is just uncertainty ahead. Again, it's the trade issues. Earnings season right around the corner. In fact, after the close of the day, we got a warning from Red Hat, a big-time name, down big. And then general anxiety or angst, right, also known as Murphy's Law. We just feel like it's been so good it could get bad. But you have to learn to buy these dips because they have been working out very, very well. And don't forget, the Federal Reserve just said that banks could survive Armageddon. So why are you worried?